Hello everyone, Assalamu alaikum. First, I would like to thank our honorable teacher for initiating this presentation system. Now let me introduce our group. I am MD Sakib Shikdar. My fellow members are Mohima, Anika, Shuchana, Tanim and Masood. Now come to the main point. Our presentation topic is types of dividend. We have divided this topic into several sections. These sections are the definition of dividend, types of dividend, cash dividend, stock dividend, bond dividend, property dividend, liquidating dividend, and conclusion. Each of this section will be discussed by me and other members of our group. Before diving into the main topics, first we need to know what is dividend and its purpose. This will give a clearer picture of the topics. And my introductory part is what is dividend. So, what is dividend? Dividends are payments made by a company to its shareholders, usually in cash or stock, representing a portion of the company's profit and purpose. They are designed to reward shareholders for their investment and encourage long-term ownership. So that's all from my part. Next, Mohima will continue his discussion. Thank you everyone.
Thank you, Sakib. Namaskar everyone. First of all, I would like to express my gratitude to our honorable teachers and all of my group members. Before starting the presentation, let me introduce myself. This is Mohima before you. The segment of my discussion is types of dividend and the definition of cash dividend. Now let's get started. We see that definitions are 5 types of dividend. Now, definition of cash dividend. If the dividend is paid in the form of cash to the shareholders, then it's called cash dividend. Cash dividends are common and popular types, followed by majority of the business concerns. Example of, if a company announces a dividend of Taka 1 per share and investor holds 100 shares, they would receive a payment of Taka in 100 in cash. My discussion ends here. The next topic of discussion is stock dividend. I am calling Anika for this discussion. Thank you for your close attention.
Thank you, Mohima. Hello everyone, Assalamu alaikum. A great compliment to all of you with a cluster of black roses. You know, black roses are so rare and expensive in the world. You're so special to me, that's why I'm giving you kind of floor. It's been a great pleasure for me that I'm here today. A great thanks to my honorable teachers who has given me chance to say something here. Now I will explain the definition of a stock dividend. A dividend is payment in the form of a stock instead of cash. For example, a company declares a 5% stock dividend. Shareholders with 100 shares would receive 5 additional shares. That's all about me for the time being. Thank you very much for your close attention. Now I'm calling Shuchana. To tell her about the bond dividend. Please come to the stage.
Thank you, Anika. Assalamu alaikum everyone. I am Shuchana first, and the topic of my discussion is bond dividend. So let's get started. What is the definition of bond dividend? Bond dividend is also known as dividends. If the company does not have sufficient funds to pay cash, the company promises to pay the shareholder at a future specific date with the help of issue of bonds or notes. Company may use bond dividends when they have limited cash on hand and wish to defer dividend payments. With this, I conclude my discussion. The next topic, property dividend, and will be discussed by Masood. Thank you everyone.
Thank you, Shuchana. Assalamu alaikum everyone. Let me introduce myself. This is Naimur Rahman Masood. You know I will be discussing property dividend. So let's get started. Property dividends involve the distribution of non-cash assets to shareholders, such as inventory or other securities. It is a part and parcel faculty of BBA. How it works? Rather than paying in cash or stock, The company may distribute other assets. This is order of the day, my presentation. Now I invite to Talim Hossein discuss his topic in details. Thanks all.
Thank you, Naimur Rashid. Assalamualaikum everyone. I am Tanim and I will present to you on the topic of liquidating dividend and conclusion. So let's get started. Liquidating dividend. Definition. Liquidating dividend are paid when a company is dissolving or winding down its operation. How it is worked? This dividend is usually paid when a company has sold off its assets and want to distribute the proceeds to shareholders. Conclusion. Dividends are powerful tool for investor relations. Companies choose type of dividend based on strategy, financial health and investor needs. Understanding dividends help investor make informed decision. Now, if anyone from the audience has any question, please feel free to ask. Any question?
I want to ask you a question. What is the difference between cash dividend and stock dividend?
This answer.
Cash dividend is payment when company have cash. And stock dividend payment when company have no cash but he payment by additional share.
Thank you.
Hello everyone, take my salam, assalamualaikum. Thank you for joining us today. My name is Sumaya Shetu and I am excited to welcome you to our presentation on types of dividend policy. In the next few minutes, we all be discussing our presentation topic. Now I am starting my topic, what is dividend policy? What is a dividend policy means? A dividend policy is a set of guidelines or rules a company follows when deciding how much of its profits to distribution to its shareholder as dividend. Now let's take things up by a closer look at classification of distribution. There are 6 types of dividend policy. Number 1, regular plus extra dividend policy, stable dividend policy, constant payout ratio, irregular dividend policy, residual dividend policy, no dividend policy. For that, I will hand it over to Sajjad Hossein to guide us through. Thank you.
Thank you, Shetu. Hello, I am Sajjad. Today I will describe regular parts of extra dividend policy. A regular dividend policy companies pay out dividends to shareholder every year. This type of policy is suitable to the small investor, retired person and others. If the company earned additional profit, it will provide extra dividend to their shareholder. On the contrary, if the company incurred loss, then the company provides regular dividend amount to their shareholder. Thank you, sir. Thank you, everyone. Now I am calling my next presenter, Urmi.
Thank you, Sajjad, for giving me the chance. Hi, I am Urmi. I will be discussing stable dividend policy. A dividend policy that pays an equal amount of dividend from the profits earned each year called is a stable dividend policy. No matter how high the earnings per share, the company pays a dividend equal dividend paid in the previous year. Now I call it Jihad. Thank you, everyone.
Thank you, Urmi, for giving me the opportunity to speak. In the beginning, I introduced myself. My name is Ibn Jihad. Now, my discussion topic is constant payout ratio. Constant payout ratio. A company pays a percentage of its earnings as dividends every year. It's called constant payout ratio. In this way, investors experience that fully volatility of company earnings. If earnings are up, investors get a large dividend, and if earnings are down, investors may not receive a dividend. I cordially invite my next friend Shravani to come up the stage and give the rest of the presentation.
Thank you, Jihad, for giving me the opportunity to share my voice among these people. Hi everyone, Assalamu alaikum. Myself Shamsad Jahan Shravani. Now, I am presenting with regard to irregular dividend policy. An irregular dividend policy is a dividend policy where a company doesn't have a set schedule for paying dividends to shareholders. Instead, the company's board of directors decide how to distribute profit, which can vary year to year. Now, I will call my next friend on.
Thanks, Rahul. Hi everyone, I am Mani Khawadar and I will be discussing residual dividend policy. Residual dividend policy is a strategy where a company pays dividend to shareholders only after all profitable investment opportunities have been funded. We can say that dividend to shareholders equal return earnings less return earnings necessary for capital budgeting. Now I invite my next presenter, Mr. Ijaz. Thank you everyone.
Thank you, Onik, giving me the opportunity to talk. Hi everyone, I am Ijaz. Today I am going to talk about no dividend policy. Under the no dividend policy, the company does not distribute any dividend to shareholders. It is because any profit earned and retained. Now I have finished my topic. A big thanks to all our speakers and thank you all for cooperating. Have a wonderful day. If anyone have any question, I would be happy to open up the discussion.
I have a question. What is the importance of dividend policy?
Okay, my team leader will help us.
Thank you for asking for question. That means a dividend policy is a financial guide that helps management issues dividend. This clarity is enabled because it sets explanation among investors about what potential income they might get from the investment. Thank you for your time and engagement. Have a wonderful day. Thank you.
Namaskar. Hello everyone, how are you? I am also fine. Welcome to our presentation. My name is Anup Kumar Gai and this is our team member Riya, Choyan, Zinu, Shampu, Lidi, Asad and Mehdi. Today me and my team will discuss about the factor affecting of dividend policy. Now, what is dividend policy? Dividend policy is the firm plans of action to be followed whenever a dividend decision is made. There are many factors affecting dividend policy. My next presenter, Riya, please coming on stage to carry on.
Thanks so much for calling me on stage. Assalamu alaikum. Hello everyone, this is Riya. How are you? I am fine. First, I would like to thank my honorable teacher to give me a chance to say something. The topic is factors affecting dividend policy. The first point is sources of finance. If the firm has finance sources, it will be easy to mobilize large finance. The firm shall not go for retained earnings. The second point is magnitude and trend in EPS. EPS is the basis for dividend. The size of the EPS and the trending EPS in recent years set how much can be paid as dividend. A high and steadily increasing EPS enables a high and steadily increasing DPS. When EPS fluctuates, a different dividend policy has to be adopted. Next presenter by Choyan Dash, please coming on stage. Thank you everyone.
Thanks, Priya.
Namaskar. Hello everyone, I am Charan Das. I hope all of you are well by the grace of Almighty. First, I would be like to thank my honorable teachers to say something about the topic is about factors affecting dividend policy. The third point is legal constraints. The Companies Act 1994 has put several restrictions regarding payments and declaration of dividends. Similarly, Income Tax Act 1984 also lays down certain restrictions on payments of dividends. Tax policy. Tax policy of the government also affects the dividend policy of the firm. When the government gives tax incentives, the company pays more dividends. Next presenter by Riddhi, please coming on stage. Thank you everyone.
Thanks, sir. Greetings, everyone. First of all, I would like to express my gratitude to our respected sir and all of my group members. So, let me introduce myself first. This is Riddhi Dotto, and today I am going to present the presentation on the topic of factors affecting dividend policies. The fifth point is control consideration. When the shareholders of the company prefer current dividend rather than capital gain, a high payment is desirable. This happens so when the shareholders are in low tax brackets, they are less money and require periodical income, or they have better investment revenues than the company. We will now move on to the next topic, which will be presented by your next presenter, Chato. Thanks everyone.
Thanks, Riddhi. Hello everyone. I am Shantapal. I hope all is well. My dear teacher and friends are present here. Thanks for giving me a chance to say something. This topic is everything dividend policy. Topic 7. Restrictive converts are a conditional set by debit financier to limit a broad action insurance. They maintain financial discipline. This may include restriction on dividends, additional borrowing or asset sales. Financial signals. Financial signals are referred actions taken by company aids in their financial health or future prospects to investor or maker. For example, increasing dividends signal strong financial performance. Next presenter Rima, please come on. Thank you, everyone.
Thank you, Shato, for calling me. Assalamualaikum and good day to everyone. I'm Rima standing before you. First of all, I would like to give a special thanks to my honorable teachers and everyone. To honorable teachers for giving me opportunity to say something about this topic. The topic are discussed today is factors affecting dividend policy. I'm discussing topics 9 and 10. Industry norms. The industry norms have to be adhered to the extent possible. It most firms in the industry adopt a high payout policy. Perhaps others also adopt a such policy. Aim of the company. Newly formed companies adopt a conservative dividend policy so that they can get stabilized and think of growth and expansion. This concludes my presentation. I thank my honorable teachers and everyone. I hope that you all are understand this topic. Thank you all.
Good morning everyone. Assalamualaikum. Thank you sir for giving us opportunity to speak. Let us first introduce our group. I am Robin Sen, Division of Maria, Department of Accounting, Govt, Barishal. And other members are Tashiba Toni, Suvarna, Maria Afsana, Shazid, Mahfuza Islam, Barishal. We have divided the topic into 7 parts, which are as follows. 1. Alters model of dividend policy. 2. The model was introduced by Professor James E. Walters and is based on the following assumption. 3. Key concepts of Walters model. 4. Applications of Walters model in rate of return versus cost of capital. 5. Limitation of Walters model. 6. Walters model's valuation formula. 7. Mathematical representation of Walters model. So this concludes my part. Next presenter, Tasrika Tony.
Thanks, Robin. Hello everyone, Assalamu alaikum. I am Tasrika Tony. Welcome to my presentation. I will be discussed Walters model of dividend policy. So, what is Walters model of dividend policy? Walters model of dividend policy is a model that illustrates the relationship between a company's dividend policy and its share price. Next. The model was introduced by Professor James E. Walters and is based on the following assumptions. Number 1. All earnings are either distribution as dividends or reinvest. Number 2. The value of the rate of return and the cost of capital will never change. Number 3. The entry return will be distributed among the shareholders through dividend. Next, presented by Sajid Ahmed.
Thanks, Tashrika Tony. Hello everyone. Assalamu alaikum. I am Sajid. My topic is key concept of Walters model. Number 1. Internal financing. 2. Relationship between dividends and investment. 3. Comparison with other models. 4. Importance in financial strategy. 5. Integration with share prices. 6. Dividend policies. 7. Balancing act. Thanks everyone. My next presenter is Masuda.
Thanks Shajid. Assalamu alaikum. This is Mahfuja before you, and I am excited to talk about applications of Walters model and rate of return versus cost of capital. The model hinges on comparing the internal rate of return with the cost of capital. On if R greater than K, the firm should be increased. 2. If R less than K, value of firm should be decreased. 3. If R equal K, no effect in the firm. My next presenter Maria Afsana to describe our next part. Thank you everyone for your close attention.
Thanks, Mahfuja. Hi everyone. Assalamu alaikum. I am Maria Afsana. I will be discussing limitation of Walters model. So let us study some of the limitation of Walters model. Number 1. No external financing, equity-based focus, constant cost of capital, principle, strategies, real-world implication, etc. Now I calling my next presenter, Subarna. Thanks. Thank you, Maria. My brother. Namaskar. I am Subarna and I am so excited to talk about Walters model solution formula. P0 equals D plus E minus D R divided by K whole divided by K, where P0 equals market price per equity share, D equals dividend per share, equals earning per share, E minus D equals return earning per share, R equals internal rate of return, and K equals cost of capital equity. Now let's think of by a closer look at example math. For that, I will hand it over to R3 to guide us through. Thank you everyone. Namaskar.
Thank you, Subarna. Hello everyone. Namaskar. Welcome to my presentation. I am Arati Shukla, BBA 3rd year, Department of Accounting. I will be presenting Walters model of dividend policy. The Japan Airlines Limited company, which earns $1 per share, is capitalized at 10% and has return on investment of 12%. Finally, the price of the share has optimum payout ratio using the Walters model. Solution given. Earning per share 12%, cost of capital 10%, rate of return on investment 12%. Where D is equal to 0, E is equal to 12, R is equal to 12% or 0.1, K is equal to 10% or 0.10, D is equal to 1. In this case, R is greater than K, the optimum payout ratio is 0%. D0 is equal to D plus E minus D into R by K multiplied by K. 0 is equal to 0 plus 12 minus 0 into 0.12 by 0.10 multiplied by 0.10. 0 plus 12 into 1.20 multiplied by 0.10. Is equal to 14.44 divided by 0.10 is equal to taka 144. Everyone, do you have any question?
I have a question. How the order model affect a company?
My teammate Shubhana will answer this.
Thank you. Very good. Barton model stated that a company dividend policy impact its valuation with higher dividend companies, valuation more than lower or no dividend companies. Thank you, everyone.
Assalamualaikum everyone. Welcome to our presentation. First of all, I thank our honorable sir to make a suggestion and also thank our classmates who are present here. Sir, change হচ্ছে না স্যার ই করো এখন তো করো sorry for this. Our presentation is presenting by Department of Accounting, third year, Bachelor 12, number of group 6, registration 11901247. And presenter Shoikat Ahmed, that's me, Parvin Akhtar, Habibur Rahman, Shukla Malakar, Ismail Rojan, Moriam Akhtar, and Shukriya Khan. Who are collect our presentation data? SM Imam Hussain and Shukriya Khan, and our slide made by Shoikat Ahmed. Our presentation subject is Financial Management, Chapter 4. Our topic, Gordon Model of Dividend Policy, Part 1. Here we see two photos. One is our college logo and one is a person whose name is Myron J. Gordon. He is the founder of Gordon Model of Dividend Policy. Now, we start our introduction to the Gordon Model. In financial economics, the dividend discount model (DDM) is a method of valuing the price of a company's capital stocks or business value based on the assumption that intrinsic value is determined by the sum of future cash flows from dividend payments to shareholders. Discount back to their present value, the constant growth from the DDM is sometimes referred to as the Gordon growth model (GGM). After Myron J. Gordon, the Massachusetts Institute of Technology, University of Rochester, and the University of Toronto, who published it along with Ellis Shapiro in 1956 and made reference to it in 1959. Their work brought, I believe, from the Williams 1938 book. The book name is The Theory of Investment Value, which put for the dividend discount model 8 years before Gordon and L. Shapiro. I welcome our next presenter to present the next part. Thank you so much.
Thank you, Shilpa. Assalamualaikum. Hello, audience. Good morning. This is Shukriya Khan, and a great thanks to my honorable teachers and group members who has given me the chance. Now I am to presentation a topic, Gordon model of definition of Gordon model. The Gordon model growth model is a formula used to determine the intrinsic value of a stock based on a future risk of dividends that grow at a constant rate. The explanation of Govt. The above product model indicates that the market value of the company's share is the sum of the present value of any future dividends to be declared. It can also be used to calculate the cost of equity if the market value is known and the future dividend can be forecasted. So that's all. Thank you everyone. Now I am inviting next presenter Pavna.
Thanks, Julia. Assalamualaikum everyone. Thank you to give me opportunity. This is Parveen Akhtar. Now I am going to presentation topic titled Formula of Gordon Growth Model. The Gordon Growth Model formula is based on the mathematical properties of an infinite series of numbers growing at a constant rate. The Gordon Growth Model equation is P0 equal to D1 R minus D, where D is the stock price, D1 is the dividend per share for the next year, R is the required rate of return, G is the dividend growth rate. So that's all. Thank you everyone. Now I am inviting our next presenter, Habib.
Thank you, Parveen, for calling me. Assalamualaikum everyone. I'm Habibur Rahman. Now I am going to present a topic: equation of Gordon model. The Gordon growth model formula according the market value of share equation to the present value of the future statement dividend. Here P equal E into 1 minus B divided by KE minus B into R, where P equal market price per share, E equal equaling per share, B equal retention ratio, KE equal cost of capital, R equal rate of return. So that's all. Thank you everyone. Now I am inviting our next presenter, Shukla.
Namaskar everyone. Thank you Habib. This is Shukla. Now I am going to present topic example of Gordon model. A share of Taka 100 is earning Taka 20 per year and paying dividend as 60%, as the internal rate of return 20% and cost of equity 12% find out. PO under Gordon model formula. Solution: calculation of market price per share. P0 equal to E into 1 minus B divided by K minus B into R, where E equal to 20. KE into 12%, R equal to 12%, B equal to 100% minus DP ratio. KE is equal to 12%, R equal to 20%. The model also states that when R greater than KE, the market price of the share is favorably affected with more retention. When R less than KE, retention would lead the decline in market price, and when R equal to K, do not affect the market price of the share. So that's all. Thank you everyone. Now I am inviting our next presenter, Ismail.
Assalamualaikum everyone. Thank you, Shukla. This is Ismail. Now I am going to present the topic about important assumptions of Gordon growth model. My Gordon suggests point 1, the firm is on all equity funds. The point 2, the firm has no external financing. Point 3, cost of capital and return are constant. Point 4, the firm has perpetual life. Point 5. There are no taxes. Gordon argument based on the ideology that a bird in hand is better than two in a basket. So that's all. Thank you everyone. Now I am inviting our next presenter, Nurul Akhtar.
Thank you, Ismail. Assalamu alaikum everyone. This is Mariam Akhtar. I am going to present a topic, criticism of Gordon model. First, Gordon model assumes that there is no debt and equity finance used by the firm. Second, K and R cannot be constant in the real practice. Third, there are no taxes paid by the firm. It is not practically applicable. So this is our presentation. Thank you all for listening carefully. Now we are happy to answer any question you have about the topic. What is the advantage of DGM? Thank you, Iti. The advantage of DGM is that the most company used method to calculate share price. So it's the easiest to understand.
Today is a beautiful day with some beautiful people. Hello everyone, Assalamu alaikum. Welcome to our presentation. Before we begin, let's introduce myself and my team members in front of you. My name is Sadia Rahman Suhi, roll number 1323, honors third year Department of Accounting. And the presentation group number 8. My other team members are Sumaya Akhtar Shetu. Hello. Juliana Priti. MD Dimon Hasan. I would like to thank our honorable teachers, MD Mustafizur Rahman, for organizing a beautiful session of presentation. Today our presentation topic about a bird in hand theory. As we can see on the screen, our content of the topic are understanding the bird in hand theory, origin of bird in hand theory, examples, formulas, assumption of bird in hand theory, limitation of bird in hand theory. Now I will describe understanding the bird in hand theory. What is bird in hand theory? What it means? Is it means a bird keeping in the hand? No man. Wait, we are the students of business faculty. Then how could we think about that? The bird in hand theory means on the strategy that suggests investors prefer dividend over capital. A bird in hand theory talks about the importance of having benefit in the current times versus benefit in the future times. There was a great proverb based on the theory by the saying, a bird in hand theory is a oast, two in the bush. This theory rests on the premises that investors will choose certain returns over uncertain flow. Now I would like to call our next presenter and my co-partner Sumaya Akhtar. Thank you.
Thank you, Suhi, and our all honorable teachers for giving me the opportunity. Hello everyone, Assalamu alaikum. Myself, Sumaya Akhtar Madina, roll 1324. Now my content of the topic is origin of bird in hand theory. We all have heard the name of Merritt Gordon and John Lintner came up with this theory. This theory is in response to the theory of Modigliani and Miller also. The bird in hand theory is a strategy that suggests investors prefer dividends over capital gains. This theory is based on an old saying, a bird in hand is worth two in the bush. The dividend from a stock is the bird in hand and the expectation of a big rise in the share price, which may or may not happen in the two in the bush capital gains. If we see the examples of the bird in the hand theory, The study shows that the dividend on average account for around 40% of the stock's total return over the long run. Coca-Cola is the best examples of bird in hand theory based investing. It has been regularly paying quarterly dividends since the start of the 1920th century. Moreover, Coca-Cola has raised its dividend payments every year since 1964. McDonald's and Pepsi Company are also good examples of dividend stocks. Now I will call my next presenter and my co-partner Rimun Islam to describe our next portion. Thank you everyone.
Thanks, Sumayya. Assalamualaikum. Hello everyone. Let me give a short introduction about myself. I am SM Rimun Islam Akash, Department of Accounting, degree 3rd year, Govt College, Barishal. My presentation topic the bird in hand theory formula, and I will this model helps to come share intrinsic value Gordon in order to prove the dividend has an impact on the share price. Developed a formula or a model. This formula takes into account three variables in first annual dividend payment for year on. The expected annual return on investment and expected dividend growth. Gordon Growth model formula or intrinsic value of the share. Annual dividend per share for year on divided by expected annual return on investment less expected dividend growth. This formula implies that the more a company's dividend per share is, the more expected dividend growth and the higher is the stock intrinsic value. I will call my next presenter Priyanti and to describe our next part. Thank you.
Hello everyone, I'd like to appreciate Rimon for calling me on the stage. I'm Juliana Priyoti, roll number 793. I'll be talking about the assumptions and the limitations of bird in hand theory. The assumptions of bird in hand theory. This theory has certain assumptions. Those assumptions are, a firm should have equity or it must not have any debt. Retained earnings should be the only available source of finance. The firm should have a constant retention ratio. The growth rate of earning must be constant. The firm's cost of capital should be constant and be more than the growth rate. As you can see here and in the chart, the cost of capital has increased when the dividend payout rate is at its lowest. Last but not the least, there are no corporate taxes. Next we have the limitations of bird in hand theory. Below are the limitations of bird in hand theory. It does not support the general perception that investors always aim to maximize their returns. This theory may not represent all investors, as some investors would be okay taking more risk in anticipation of more returns. It is possible that in long term, dividend income may fail to keep pace with inflation. More dividends could mean a higher payout in terms of taxes. Preference for dividends could go against firms with profitable growth prospects. This is because it is better for such companies to retain their earnings to fund growth than to pay dividends. At the end of my demonstration, I'd like to call Chuvi to continue this presentation. Thank you.
Thank you, Priyoti, for your understanding and the explanation and information of limitation and assumption of the bird in hand theory. Today, our last portion of the topic is what is the future of bird in hand theory. If a company built up on the basis of the bird in hand theory, then should be the future of the investors are investors value dividends highly than potential future capital gains. This theory is stable and also very predictable. Dividend payouts are more attractive to investors than companies. Implies this averse and prefer the security of current returns. That's all. Attention everyone, do you have any questions about our topic?
I have a question. How did the barring hand theory different from tax preference theory?
Thank you, Sohul Islam, for your question. The tax preference theory states that investors prefer earning long-term capital gains to receiving dividend income. On the other hand, the barring hand theory of dividends specifies that all investors want to earn dividend income rather than capital gains, owing the former certainty. Thank you. By the grace of Allah, we are not special to I am absolutely fascinated with the opportunity to perform such an idea and thought. I extend my cordial gratitude to our course instructor and Mustafizur Rahman sir for giving me this opportunity. Advance thanks to my beloved classmates for paying close concentration. From the 7, Mrs. Janatu and my other team members. SK Shumon, Pritam, Miss G, Johul Islam, Vidhi, Kedu, and Nipanumri. Welcome to our presentation. Now we represent our presenting topic, the effect of present on the balance sheet. Let's see from Shumon.
Hello everyone, Assalamu alaikum, this is Shumon and I am very excited to talk about my topic. My topic is effect of stock dividend on the balance sheet. Dividends are a form of payment made by a company to its stockholders out of its profit or reserves. The payment of dividends affect the balance sheet of a company in various ways. The effect of dividends on the balance sheet is important to understand, as it can impact the financial position of a company, its shareholders. There are five effects of stock dividend on the balance sheet. Number 1, reduction in retained earnings. Number 2, increase in liabilities. Number 3, impact on shareholders' equity. Number 4, impact on share price. And number 5, options for dividend payment. Our next presenter, Pritham Ghosh, please come and talk about the next.
Thank you, SK Shumon. Good morning, everyone. I am Pritham Ghosh. First of all, I would like to thank my teammates and judges for giving the opportunity to speak. Today, my topic is reduction in retained earnings. I am going to straight to my discussion. When a company pays dividends, it reduces its retained earnings. Retained earnings are a portion of a company's profits that are not distributed as dividends but are instead kept for reinvestment in the business. A reduction in retained earnings due to dividend payments can impact a company's ability to finance future growth and expansion. Thank you again, everyone. I request my next speaker to discuss the remaining part.
I am how are you everyone? My group number 7. Today my topic is option for interest and liabilities. Now I am going to state my discussion. Interest and liabilities. Dividends are typically paid off of a company. Earned accumulated profit. When a company declares a dividend, it carries liability on its balance sheet. This liability represents the amount of dividend to be paid to shareholder. The payment of dividend reduces this liability, but until the dividend is paid, it remains on the balance sheet as a current. Thank you, everyone. Special thanks all your teachers, suggestion and presentation. I request my next speaker,
Assalamu alaikum. Myself Joyful. I would like to my honorable teacher and my teammate to give me the opportunity and to speak. Today my presentation is the effective of share price. So I direct discussion it. Dividends paid to shareholders reflect the equity in the company. Shareholders' equity represent decided that in the assets of sorry sir. Sorry sir. Impact on share price. Dividend can also impact a company's share price. The payment of dividend is often seen as a sign of financial stability and strength, which can attract investors and increase demand for the company's share. However, a company pays out too much in dividends, it may be seen as a negative sign, as it may indicate that the company is not investing enough in its future growth and expansion. Thank you again everyone. I request my next presenter to discuss the remaining part.
Assalamualaikum. I am Rehanatha from Group 7. First of all, I would like to express my gratitude and thanks to Mustafa Rahman sir for organizing such a beautiful debate, and also thanks to all group members. I present this topic, impact on share. Dividends can also impact a company's share price. The payment of dividends is often seen as a sign of financial stability and strength, which can attract investors and increase demand for the company's shares. However, if a company pays out too much in dividends, it may be seen as a negative sign, as it may indicate that the company is not investing enough in its future growth and expansion. Thank you again everyone. I request my next speaker Pijus Kanti to discuss the remaining part. Assalamualaikum.
Thanks Rehana. Good morning everyone. I am Pijus Kanti Kait. First of all, I would like to thank my teammates and judges for giving me the opportunity to speak. Today my topic is option for dividend payment. I am going straight to my discuss. Companies have several options for paying dividend. They can pay out dividends in cash, stock, or a combination of both. Cash dividends are the most common form of dividend payment and involve the distribution of cash to shareholder. Stock dividend, on the other hand, involve the distribution of additional share of stock to shareholder. Companies may also choose to pay out a combination of cash and stock dividend. Thanks again everyone. I request my next speaker Nipanandi to discuss the remaining parts.
First of all, thanks Rajesh and teammates give me a chance. Hello everyone, good obeisance to all of you. This is Nipanandi before you. I would be discussing how effect of stock dividend on balance sheet for the example. Here is the question. Monopoly Paper Mills Limited has the stockholder equity account given below. The firm stock has a current market price of $500 per share. Source of capital: preferred stock 5 lakh, common stock 10,000 share per share at $100, 10 lakh. Additional paid up capital 12 lakh, return earnings 23 lakh, total shareholder equity 50 lakh. Record show the effect on monopoly paper mills of a number of 1 5% stock dividend, number of 2 10% stock dividend, number 3 25% stock dividend.
There is solution. Working for 5% stock dividend. Number of new share issued. Working number 2, number of total share. Working number 3, return earnings transfer. Working number 4, new return earnings. Working number 5, new additional paid up capital. Working number 6, total additional paid up capital. Next, monopoly paper mills table for stockholder equity capital after 5% stock dividend. Now, do you have any question?
Does stock dividend affect total assets and liabilities?
Thanks, Rahat. No, stock dividend does not affect total asset and liabilities. Thank you. Thank you all. Have a wonderful day.
Next, number group.
Today is a beautiful day with some beautiful people. Hello everyone, Assalamualaikum. Welcome to our presentation. Before we begin, let's introduce myself and my team members in front of you. My name is Sadia Rahman Suhi, roll number 1323, honors third year Department of Accounting. And the presentation group number 8. My other team members are Sumaya Shetu. Hello. Juliana Priti. MD Dimon Hassan. I would like to thank our honorable teachers, MD Musafizur Rahman, for organizing a beautiful session of presentation. Today our presentation topic about Aberdeen hand theory. As we can see on the screen, our content of the topic are understanding the Aberdeen hand theory, origin of Aberdeen hand theory, examples, formulas, assumption of Aberdeen hand theory, limitation of Aberdeen hand theory. Now I will describe understanding the Aberdeen hand theory. What is Aberdeen hand theory? What it means? Is it means a bird keeping in the hand? No man. Wait, we are the students of business faculty. Then how do we think about that? The Aberdeen hand theory means on the strategy that suggest investors prefer dividend over capital. Aberdeen hand theory talks about the importance of having benefit in the current times versus benefit in the future times. There was a great proverb based on the theory by the saying Aberdeen hand theory is a oath to in the bush. This theory rests on the premises that investors will choose certain returns over uncertain flows. Now I would like to call our next presenter and my co-partner Sumaya Akhtar. Thank you.
Thank you, Suhi, and our all honorable teachers for giving me the opportunity. Hello everyone, Assalamualaikum. Myself, Sumaya Akhtar Madina, roll 1324. Now my content of the topic is origin of Aberdeen hand theory. We all have heard the name of Maron Gordon and John Lintner came up with this theory. This theory is in response to the theory of Modigliani and Miller also. The Aberdeen hand theory is a strategy that suggests investors prefer dividends over capital gains. This theory is based on an old saying, a Aberdeen hand is oath to in the bush. The dividend from stocks is the Aberdeen hand and the expectation of a big rise in the share price, which may or may not happen in the bush capital gains. If we see the examples of the Aberdeen hand theory, the study shows that the dividend on average accounts for around 40% of the stock's total return over the long run. Coca-Cola is the best example of bird in hand theory, best investing. It has been regularly paying quarterly dividends since the start of the 1920th century. Moreover, Coca-Cola has raised its dividend payments every year since 1964. McDonald's and Pepsi Company are also good examples of dividend stocks. Now, I will call my next presenter and my co-partner, Rimon Islam, to describe our next portion. Thank you, everyone.
Thanks, Sumayya. Assalamualaikum. Hello everyone. Let me give a short introduction about myself. I am SM Rimon Islam Akash, Department of Accounting, degree third year, Govt College, Barishal. My presentation topic the bird in hand theory formula, and I will give this model helps to come share incentive value Gordon. Gordon, in order to prove the dividend has an effect on the share price, developed a formula or a model. This formula takes into account three variables in first annual dividend payment for year on, the expected annual return on investment and expected dividend growth. Gordon Rose model formula or incentive value of the shares. Annual dividend per share for year on divided by expected annual return on investment less expected dividend growth. This formula implies that the more a company's dividend per share is, the more expected dividend growth and the higher is the stock intrinsic value. I will call my next presenter, Priyanti, and to describe our next part. Thank you.
Hello everyone, I'd like to appreciate Rimon for calling me on the stage. I'm Juliana Priyoti, roll number 793. I'll be talking about the assumptions and the limitations of bird in hand theory. The assumptions of bird in hand theory. This theory has certain assumptions. Those assumptions are, a firm should have equity only, or it must not have any debt. Retained earnings should be the only available source of finance. The firm should have a constant retention ratio. The growth rate of earning must be constant. The firm's cost of capital should be constant and be more than the growth rate. As you can see here in the chart, the cost of capital has increased when the dividend payout rate is at its lowest. Last but not the least, there are no corporate taxes. Next we have the limitations of bird in hand theory. Below are the limitations of bird in hand theory. It does not support the general perception that investors always aim to maximize their return. This theory may not represent all investors, as some investors would be okay taking more risk in anticipation of more return. It is possible that in long term, dividend income may fail to keep pace with inflation. More dividends could mean a higher payout in terms of taxes. Preference for dividends could go against firms with profitable growth prospects. This is because it is better for such companies to retain their earnings to fund growth than to pay dividends. At the end of my demonstration, I would like to call Chuvi to continue this presentation. Thank you.
Thank you, Priyoti, for your understanding and the explanation and information of limitation and assumption of the bird in hand theory. Today, our last portion of the topic is what is the future of bird in hand theory. If a company built up on the basis of the bird in hand theory, then should be the future of the investors are investors value dividends highly than potential future capital gains. This theory is stable and also very predictable. Dividend payouts are more attractive to investors than companies. Implies this averse and prefer the security of current returns. That's all. Attention everyone, do you have any questions about our topic?
I have a question. How did the bird in hand theory different from tax preference theory?
Thank you, Zahul Islam, for your question. The tax preference theory states that investors prefer earning long-term capital gains to receiving dividend income. On the other hand, the bird in hand theory of dividends specifies that all investors want to earn dividend income rather than capital gains, owing the former certainty. Thank you.
Thanks for